one big, beautiful bill is a hodgepodge of random provisions. Not my words. Those are the words of Dana Ansbach, the CEO and founder of Sensible Money, who joins me now to walk us through the one big, beautiful bill, who it benefits, and who is impacted negatively by it. Dana, welcome.
Hi, Bob. Glad to be here. And yes, hodgepodge is the right way to describe this bill. Not only hodgepodge, but it impacts each household that we've looked at differently. So it becomes very difficult to provide any kind of broad rule of thumb. And so that's made it even more challenging. I know you and I are going to talk about some of the specific provisions, and we're going to do our best to break it down and make it understandable. But there's a lot in that bill.
Yeah. So when you think about the key provisions, there's some people that benefit. There's some universal wins, so to speak.
I do think of universal wins. And so I do want to clarify also, we are talking about the federal and income tax and in one case, estate tax provisions of this bill, not some of the other provisions of the bill. I know can be a lot of political sentiment around it. So we are simply looking at when we run plans with the new tax rules versus before these tax rules, what has been the impact on these households and what are we seeing? And so what I describe as the universal wins is really the rates were set to go back up to where they were prior to 2018. And so in most of the financial plan modeling tools that are used, that was built in. We assumed a slightly higher tax rate starting next year. And so when we rerun those with now the rates staying the same, it makes the plans look better. Ultimately you pay less taxes, you have more money to spend, or else you have more wealth that you leave at the end of your lifetime. And we measure that in the simplest way, a measure called fundedness. So we look at the present value of all your projected expenses over a lifetime, and those expenses include taxes. And we compare that to your financial resources that are available to cover those expenses. And in every case we've looked at, fundedness has improved, I would say, approximately 3%. In some cases, even more, 6%, 7%. And so I think of that as at an individual household level as a universal win, right? It has improved the outcomes as we project them in these households. Now, there's some smaller provisions that are built into that. And, of course, to make it even more confusing, some things start this year in 2025 and some things start next year in 2026. And so we'll see if we can keep them all straight. This year, 2025, we have a slightly higher standard deduction. So it's $750 more for singles and $1,500 more for couples, I believe $1,500. And so, that's going to impact everyone who doesn't itemize. You're going to have this slightly higher standard deduction. And then next year, 2026, there's a slight expansion of the 10 and 12% tax brackets. And so that means even if you're in a higher tax rate, some of your income, a slightly larger portion, is going to fall into those 10 and 12% rates. And so those three things combined are what I call universal wins, meaning they're going to impact all taxpayers. And in some way or another, that results in less tax paid. Now, there's other provisions that could counteract that, but in general, that's what I call a universal win.
There's a big universal win for older adults, 65 and older as well.
Well, there is an extra senior deduction. I don't know if I would call it a universal win. It impacts people who have modified adjusted gross incomes less than $150,000 for singles, less than $250,000 for joint, and married filing jointly, I should say. I don't believe you get the deduction at all if you're married filing separately. And so, that's why I wouldn't be able to call it universal. But if your modified adjusted gross income falls underneath those levels, you will see the deduction. Now, you have to be over 65, and it's applied to each spouse differently. And so, if one spouse is over 65, they could get the deduction. When the other spouse is also over 65, they could qualify perhaps for both deductions, but that income phase out is applied. And so you have to be cautious of that. What that's going to do is make certain withdrawal strategies even more complicated. Roth conversion decisions, it's going to make them more complicated. What if we have a client that you were going to do a Roth conversion for, but now it's going to push their income over that limit? If they could potentially lose $12,000 of additional deduction, if they were both over 65, you're going to have to weigh all of that out and say, well, is that Roth conversion still worth it? So, and this is what makes it so challenging, is every household has to be looked at individually, and it can be really challenging. What if someone has a mutual fund that's not very tax efficient, and at the end of the year, it delivers a large capital gain distribution? Well, you wouldn't have factored that into a tax model or a tax projection if you didn't know it was coming. And so that, again, could push you over that limit. You could lose the deduction. You might have done everything you thought was correct to plan for it. And then, some kind of investment event causes an extra tax that you weren't considering. So it's a challenge.
Yeah. It should also be noted that there's that deduction expires in 2028. It's not a permanent deduction.
Good point. Yes. So not only do we have different dates where some things start this year, some next year, some of the provisions are temporary and set to expire in 2028. I believe some may be in 2029. And then others are, quote, permanent. By permanent, that just means they don't have a sunset attached to them. But of course, future legislation could come in and change those.
I know many young people are now putting down less than 20% on their house to purchase it, in which case they would have to get private mortgage insurance, but there's a provision in there that might benefit them?
There is. And so, you can deduct mortgage interest up to the first $750,000 of debt used to acquire the property. And that provision was changed. I believe it, went into force in 2018, back with the TCJA, Tax Cuts Jobs Act, if I'm saying that right. And they're making that stay. So it was set to expire, but that is staying. And so on top of it now, they're including the mortgage insurance as part of that deduction. And that is typically something that you pay if you put less than 20% down and have either an FHA or a VA loan. And so it wouldn't only be young people. Sometimes we have people near retirement who went through a divorce. Maybe they're buying a house. Maybe they went through a job loss or a bankruptcy and they're starting over and rebuilding. So this would also benefit people in that situation. On another note, I read something this morning that I wasn't aware of. And so I don't know when this came into effect, but there was a provision that said if you, I believe either, let your house go back to the bank or debt was forgiven in some way, you could exclude that debt from income. And so, people who went through a financial situation, maybe they didn't file bankruptcy, but for whatever reason, they let their house go. Normally you would get that was forgiven debt. That's taxable income to you. And so there's been a provision that said, no, we're not going to make you pay taxes on that. Well, that has been removed. Now I didn't catch in my mind whether that starts this year or next year. My guess is 2026 is when that starts. And hopefully we don't have a lot of people underwater in their homes or, in too much debt, but it is something to note. I think, coming out of the Great Recession, there was a lot of, people who had to let their houses go. And that provision was put in there. So trying to give them a little bit of a break on that. And
Yeah.
that will be no more.
Yeah. One thing with respect to the mortgage interest and mortgage insurance deduction, if you're taking the standard deduction, you may not benefit from this, but if you're itemizing, you would.
Correct. Yes, good point. And a lot of people now are itemizing deductions. And even with the higher itemized deduction, that's going to mean even more people are going to be better off itemizing. There's also been this interesting, situation where depending on what state you live in, you may not need to itemize for federal taxes, but sometimes it still makes sense to keep track of all of that and itemize for your state taxes. Now, a lot of people aren't going to keep the records that they need to keep. They're just going to kind of say, well, state taxes are, depending on what state you live in, maybe aren't as big, and I'm not going to go to the trouble to save all of that. But just because you're itemizing for federal, you have to keep in mind there could still be some tax savings for keeping all of those records and tracking everything at the state level.
Yeah. Just to backtrack for a second, with the senior deduction, it doesn't matter whether you're itemizing or taking the standard deduction. It counts either way.
Correct.
Yeah. All right. One of the funnier ones, I guess, is what, the auto loan interest deduction? Is that how you put it?
Yeah. So there's this, again, this applies to taxpayers with modified adjusted gross incomes less than 150 single, less than 250 for married. But you can deduct the interest, the first $10,000 of interest on auto loans. There's some specific qualifications. The vehicle needs to be assembled in the U.S. It needs to be purchased with a new loan. There is a case where you could refinance it as long as you didn't increase the balance, and it would still qualify. But, just running some rough numbers out, my initial thought was like, well, how many cars are people buying where they're paying $10,000 of interest a year? And then I was talking with a colleague who reminded me that a lot of families with teenagers, young adults in the household, could have multiple cars that they're buying. And so it made a little more sense in thinking about who or what set of demographics does this really benefit the most. And it may be those households with a teenage or young adult children where they do have multiple vehicles.
Yeah. We had 5 cars in our household at one point.
Now you have triplets, right? So
I do. So we didn't quite have a car for every person in the house, but we came close.
Yeah, that makes perfect sense. So this would have been a provision maybe perhaps useful to you at that point.
A little too late for me to take advantage of it now, but that's okay. But there is an interesting, during the campaign, President Trump talked about providing deductions for qualified tips and overtime, and it's a provision in the bill.
It is. And again, it has some limits. And so, it applies to those same limits, modified adjusted gross incomes, less than 150 single, less than 250 married. And then there is a cap. So it's the first 25,000 of qualified tips. And of course, there's going to be some specific rules in terms of what qualifies and what doesn't. And the same, there's some limits. The first 12,500 of overtime for singles, 25,000 for married filing joint. And where I see this is really benefit, working Americans. When I think of, retirees who are trying to work a second job, this could be something if they're working in a service industry where they qualify for tips. People who are really putting the effort in, it is giving them a break. Their incomes aren't, at what we would call that mid to higher range. And that's where the benefit lies for them. And so it's really interesting. The other interesting thing, because, I believe there was a campaign slogan around no tax on Social Security. And people have equated this new senior deduction to be, similar to that. It really isn't no tax on Social Security. And so I've seen some misleading articles online on that. And so, it is not no tax on Social Security. Many people will still pay taxes on Social Security. It is just a due deduction for seniors, people over 65. Again, you could claim Social Security at 62 and this new senior deduction wouldn't apply to you. And so I just want to make that clarification. If you see things saying, yay, there's no tax on Social Security. Well, that is not true.
Yeah. Another provision has to do with charitable deductions for non-itemizers. A lot of folks do give money, but not perhaps enough along with other items to qualify to itemize their deduction. So there's a benefit here that with this provision.
Yeah, I think, again, for people who don't itemize, which you may know these stats, was it last time I looked, it was like 65 to 70% of tax returns now use the standard deduction. I think I saw that statistic float around. Does that sound right?
It might have been even higher, but it's expected to go lower now to a greater percentage of taxpayers will begin to itemize because of certain things in the in the
because
bill.
of perhaps the new increase in the SALT deduction that
Right.
we'll get to in a minute. Yeah.
Yeah.
Well, think about, again, it's a large percentage, more than 50, we know,
Yeah.
who don't itemize. And oftentimes they may be contributing to charity. Maybe it's a local dog shelter, food bank, or, might be a couple $100s. Now up to the first 1,000 for singles, 2,000 for marrieds, they can take that deduction. They don't have to itemize to get it. And so they are receiving a little bit of tax break for the assistance that they may be already providing to charitable organizations.
Yeah. The most talked about, I think, provision, and the one that I think surprised the most people, was the SALT deduction increase. I live in a high tax state. I live in Massachusetts, and increasing it from 10 to 40 is of great benefit to at least me. I'm sure others as well.
Yeah, I mean, it's a benefit to many. So again, it was $10,000 of state and local taxes that you could deduct. It was capped. Now, before that cap, it was unlimited. And so people that lived in high income tax states, Massachusetts, New York, Connecticut, California, really were impacted by that cap at 10,000. Well, now they've raised it to 40, but again, it has a phase out. And so that phase out starts at 500,000 of modified adjusted gross income. And then by the time you exceed $600,000 of modified adjusted gross income, you are back down to that $10,000 cap. But for everybody who has, under 600,000, which is the majority of people, of adjusted gross income, then yes, they're going to see likely some kind of a benefit. And as you said, we talked about earlier, maybe they will be able to itemize now, and it will make sense versus taking the standard deduction.
We mentioned at the top that this bill also dealt with the estate tax. That people also were grappling with whether the exemption would be lowered or stay the same or go up, et cetera. But here we are. There's a provision in there for that.
It went up. So starting in 2026, 15 million per person. So between a married couple, that means 30 million that you could pass along free of estate tax. Now, estate tax is not the same as income tax. So if you have IRA assets, right, your heirs are still going to pay income tax on that. I like to always make that clarification. The other thing people get confused by is the gift tax. So you can gift, is it 19,000 a year right now?
Right.
The limits have changed so many times, and I've been doing this for 30 years. Sometimes the exact number gets jumbled in
We'll
my
call
head.
it
I love the
thereabouts.
internet. But yeah, about 19,000 a person. And people get confused because no taxes are paid when you give under that limit. No taxes are paid to the person receiving it. You don't get a tax break. So I've seen people think, oh, if I gift this, I get a tax break. No, you've just been able to give this tax-free to anyone. Actually, it doesn't have to be a related. And if you give over that limit, you still don't pay a tax. You just file a form that basically says, if I'm going to give, let's say, $100,000 to one of my children to help them with a down payment, I'm going to file a form that says I'm now using up some of my $15 million that I'm allowed to give tax-free. So anytime estate taxes come up now, I try to make that clarification because I find a lot of people think if they gift over that limit, somehow there's going to be a big tax bill associated with it. It's not. It's just a form you file.
So there are some provisions that hurt early retirees that are worth talking about?
There are early retirees. In this case, we would define as before 65. And so in 2021, there were some changes made to the healthcare tax credits. So if you purchase a healthcare plan off healthcare.gov and your income was under certain qualifying limits, you were eligible for these tax credits that helped subsidize the cost of your plan. And I've seen households receive, $20,000, even $30,000 a year toward covering their healthcare insurance costs, which is a big number. $20,000 a year. If you were looking at a household, in one case, their premiums were going to be $1,500 a piece, which is a lot. We're talking $3,000 a month in health insurance costs, and they received almost a $30,000 subsidy. So they only had to pay $6,000 for that health insurance. Now, from 21 to 2025, there was a set of formulas in place that basically allowed a lot more people to qualify for this healthcare tax credit, and those are going away. And so it's much more of a cliff. If your income exceeds this amount, that's it. You're not going to qualify for any type of credit. And I do think that's going to impact a lot of people who were retiring before 65. They didn't have access to retiree, employer covered health insurance. And so it's going to make it a lot more expensive for those people to leave the workforce before 65.
Yeah. And I suppose for anyone who is in the ACA program now and is receiving the advanced premium tax credit, they may have to think about changing their plan from a gold to a bronze, or a bronze to or a silver to a bronze, or bronze, right? Just in general, they're going to have to rethink the coverage they have.
Yeah. And so, as you pay more premium, for example, the gold or the platinum plans, you're also expected to pay less out-of-pocket costs. So you could switch down to a silver or a bronze plan. You're going to pay less in premiums, but if you have a health event, you may pay more in out-of-pocket costs. And so really it's a case-by-case basis. You need to work with a solid insurance agent on that who can evaluate your health conditions. I always, one case comes to mind of someone who had been extremely healthy and never had any health issues, blood work, everything was stellar. And she chose the plan with the lowest premium and ended up getting diagnosed with breast cancer. And so had her maximum out-of-pocket costs for several years in a row. And so in hindsight, she realized, it would have actually saved her money to pay for the higher premium plan. But you don't know some of these things ahead of time. So, but you can assess if you have conditions that put you at higher risk, high blood pressure, cancer, why is my brain diabetes? My brain wouldn't come up with the word. But there are certain conditions that you may say, well, is paying the lowest premium really the right thing for me, or could that cost me more in the long run? But definitely, if you're under 65 on an ACA plan, open enrollment starts, is it November? I just don't, maybe November 15th.
Somewhere there.
Somewhere, this fall, then you're going to want to work with your agent and really evaluate your options carefully.
Yeah. I'm not a gambler, but there was a provision in the one big, beautiful bill that deals with gamblers.
There is. And the reason I think this could impact more retirees is, I'll never forget this client I had. And on his tax return every year was $500,000 of gambling winnings and losses. And I thought, wow, that's a lot of time at the casino. But his wife had passed, and this is how he spent his time. It was his social activity. Here in Arizona, there's several casinos. They're close, so it wasn't a long drive. And so it was truly his form of entertainment. Now, in his case, the winnings, losses offset the winnings, and it was a wash every year. However, the way it works in the tax return, it still inflated his modified adjusted gross income. And there's other provisions tied to that, such as your Medicare premiums. So, he was paying these large Medicare premiums. If he wasn't a gambler, he wouldn't have. Well, now it's even worse. So now you can only deduct the first 90% of losses against winnings. And so hopefully I'm saying that correct.
Yeah.
In this case, it would mean in this client's case, even though he had $500,000 of losses and $500,000 of winnings, he would still have to claim an extra $50,000 of income on his return. He wouldn't be able to use all of the losses to offset the winnings, only the first 90% of them. And so there's a lot of sports betting that has taken off. I know there's a group I meet with my dog, and there's several retirees, and they, are always talking about the games and the bets they've placed. And so when I think about, people who enjoy that, this could have a negative impact on them.
Yeah. I take it that the gambling industry was not successful in lobbying
I
lawmakers.
think it was one of the tax specialists I know you and I follow, Jeff Levine, who had put some commentary that he thought perhaps we would see that provision changed. So maybe the sports betting, is going to put together a lobby together and say, "Hey, you got to change this." But as of now, that's what it
Yeah,
says.
a word of warning to those who find this as their hobby. Um, Charitable deduction changes for itemizers. There's something there for us to talk about as well.
There is. And so starting next year, there is a 0.5% of adjusted gross income floor, and you don't get to use that amount of your charitable deduction. So using an example, let's say you had, $200,000 of modified adjusted gross income. Well, 0.5% of that is going to be $1,000. And so if you donated $3,000 to charity and you were going to itemize, well, you would only get to use $2,000. Your first 1,000, 0.5% of your adjusted gross income, would be ineligible for that deduction. And so we've seen cases where clients have restricted stock units or options they're exercising. Now, they may have modified adjusted gross incomes, $2-3 million, because of these stocks that are being granted to them or vesting. And so that would be a substantial amount of a charitable contribution that you would lose if you're in those higher income brackets. So in a few cases, we've suggested accelerating the amount they would normally contribute to charity into this year, 2025, using a donor advised fund. And then you front load all those contributions up until the point you're going to be eligible for qualified charitable distributions from an IRA, which begins at 70 and a half. And so you can add up, well, I would normally contribute or donate about this much to charity. Let's say it was, $5,000 a year over 10 years. So I'm going to put $50,000 in my donor advised fund this year, get the maximum benefit for it. I won't donate anything for the next 10 years. Then I will be 70 and a half, and I will switch my donations to come out of the IRA, which becomes one of the most beneficial from a tax standpoint ways to donate now. So this is one that I do think impacts, of course, the higher your income, the more it's going to impact you. But there's a lot of people who ought to at least look at front loading their charitable contributions and using a donor advised fund. Maybe they wouldn't have used one before. I'm actually one of those people who, I just like to donate when I want to donate. And now I'm like, okay, I may consider front loading a donor advised fund myself, because it's going to be more beneficial for me tax wise to do that than to just keep, doing a little bit each year.
Yeah. I know we're going to talk about the planning opportunities that come because of this bill, but all this just serves to remind anyone who's listening of the need to work with a planner who can uncover opportunities that you may overlook because you don't know about them, or you haven't thought about them, or you didn't even know about them, right? You're just sort of you're going about you're good at your day job, but this now is an opportunity that is lost on you because you're not knee deep in it.
Yeah, and these opportunities are subtle in some cases. In other cases, they're big, but they do make a difference, and that is what a planner is for, right? Their job is to look at these kinds of opportunities and tell you, yes, this one applies to you. No, this one does not. Here's how you would take advantage of that. Here's why this would make sense for you or why it wouldn't. They know your whole situation. You and I can talk in generalities, but we don't know anybody's individual situation. And I know when I do webinars and when you write articles, we see so many comments. Should I do this or should I do that? And we would love to be able to answer you, but it's impossible. I think I wrote in the article you and I were talking about that, you can't do this without software, which I agree. And I said, perhaps Einstein could. I mean, it's just, it's, it takes more time now because of these rules and because they impact each household differently. You have to be more careful. Weren't they talking about simplifying the tax code a few years ago? Remember when they came out with the new simplified 1040 form,
Yeah.
which didn't work too well?
Did it?
Well,
Yeah. I don't
that
recall.
didn't last. It's
Yeah.
not simpler at all.
Yeah. So as you think about your universal conclusions, the two things that you've seen hold true in every single plan so far, as you think about the one big beautiful bill, what are those things?
Yeah, I mean, the universal conclusions would be it has improved outcomes. We define outcomes, as I said at the beginning of our conversation, in terms of metrics such as fundedness, or some people use Monte Carlo analysis, but it has improved outcomes in every plan we've looked at. And two, it has added complexity. So those would be my two universal conclusions. I think the third, I said it gives me a giant headache.
I have some Advil for you. Yes.
Yeah, I think all of us planners, I know here at our firm, are very busy going client by client to understand the impact. And so we do tax projections in the fall, and we have an email newsletter getting ready to go out to clients to let them know that we will be reaching out to them one by one to address how it impacts them. I mean, we'd love to be able to send some kind of a group email, but it's impossible. Each household is unique, and this makes it even more so.
Yeah. One of my favorite sayings is that every person has a unique fingerprint, and so it does require a row by row, column by column, cell by cell analysis, right?
It really does. It really does, more so than ever.
Dana, we've covered, I think, a ton of ground here. The important points in the one big beautiful bill. Anything we missed, or just bears reemphasizing?
There's so much more in the bill that we haven't covered. I really tried to focus it on individuals and really individuals near retirement, but there are some interesting provisions for people who own small businesses and corporations. And so that's probably a whole different video you could do with someone to go through those provisions. So know that we've focused on a narrow subset of what's in there, because that is what I do in my practice, and what our firm does is really focus on retirement people in that 55 to 70 demographic and how it impacts them.